Good day, fellow investors. It's Monday, 7 April 2025, and there is a bloodbath on global markets. What we need to discuss is what's going on, the current situation, the soft, the hard data, the outlook, the things we can possibly know versus what we can't know, and then how to position ourselves when it comes to investing. Let's start with the good and the bad of tariffs. This is the situation now. Now we have the first retaliation from China, and when you attach these costs to global tariffs, then you know that the cost for everything will go up and therefore there will be less global trade. On top of things, supply channels will be disrupted, rare earths from China, and Trump says China played it wrong. But when it comes to the current situation, the key is that these are tectonic shifts to how the world was last week and how the world will likely look in the next years, perhaps even decades. And that is why the markets are reacting like they are justified when it comes to the reaction. Trump, of course, rejects market fears, everything's going to be great, we're going to become a wealthy nation again, wealthy like never before. When it comes to wealth, how do you measure wealth? Americans live on average 7 years less than Swiss people. Is that wealth? But we can discuss those things forever. This was the wealth before the tariffs. Likely this is going to change, so we are seeing wealth destruction. JPM is predicting already a recession for the US, thus even more wealth destruction coming from the current situation. Besant says that all the countries have been bad actors for a long time. We have to see how to rewind 20, 30, 40, 50 years of bad behavior. Trump says that he is going to focus on surpluses. He was elected on this, and that the market is just medicine that has to be taken to make America great again. Just a funny note here, if we look at the US trade balance, so it was around 73 billion stable, and then it really exploded to double almost over the last few months as everyone is rushing to buy in before the tariffs. And you can see here the US trade balance deficits, and you can see the huge deficits that are now as everyone is rushing to buy before tariffs. We'll see later if the deficits will change, or likely will, and therefore also less than expected benefits for the government's budget. But when it comes to markets and scenarios, where will be the bottom? This is the current situation. The S&P 500 is already down 17% from the top a month and a half ago. All other markets are in the red, and also treasuries are down significantly. So not inflation expectations, but the bond markets are telling us recession expectations, lower Fed rates, and that is because consumer behavior might change as the markets go down, as also everyone invests less because of the high uncertainty. Everything is on the table now. Because if we look at GDP in the US, 68% is consumption. However, if we look at the consumer balance sheet, more than half of it is stock market, pension funds, other financial assets, and of course, the rest is homes. In this situation, when it comes to the markets, people might stop buying, stop refurbishing, stop doing this, and that is what leads into a recession. On top of everything, businesses stop investing because of the uncertainty, and there you have another recession. You stop hiring, you stop expanding, and that is then the spiral that reverts. We now expect real GDP to contract under the weight of tariffs and for the full years based on the current situation. We don't even know what will next week the impact look like. Some say there will be a stagflationary forecast. Maybe the situation will be that bad that there will be no inflation at all, just a bad recession. But we can also have positive situations there, like some deals. So Trump is expecting a big tariff on Europe and that everyone will react, bend over, and accept whatever Trump wants. And he also says that there are 7 trillion already committed to be invested in the US to make America great again. However, when you look at the situation, for example, Europe, US, there is 1.5 trillion of trade. Yes, there is a goods deficit, there is a services surplus, so there is some deficit. What is this? 150 billion, but the deficit is on 1.5 trillion of trade. So tariffs will impact this huge trade, and Macron already says how they should stop investing in the US. And the key question is, when it comes to business, if you are an investor, if you own a company, if you are a CEO, you're looking, okay, at the certainty of your investments. Markets, news, everything reacts immediately, but you look 5 years ahead. You want to get a return on investment. You want to be sure on that return on investment. You're not going to gamble with your company and then everything retreats, everything pauses, which leads into a recession. Bill Ackman says how it is a mistake to do these kind of tariffs. Ray Dalio also adds that there will be huge uncertainty ahead, and you can see here will be significantly stagflationary at the first order of magnitude, but then on the second order of consequences there will be other things. We'll see other countries' responses, policy changes, and all that other countries are trying to do to negate these undesired effects, monetary and fiscal policies. So other countries might have more room because their prices will be lower than US prices and therefore more room for fiscal and monetary activity. But the key here, and this is the best prediction, we have in store many big surprises and changes ahead. I urge you to read Ray Dalio's view on tariffs. He is perhaps the best historian out there when it comes to what has been going on and what might go on. Tariffs are responded to by the tariffed countries, currencies are changed, monetary policies are changed, fiscal policies are changed, and everything changes. These are the tectonic shifts that are likely impossible to comprehend now, and we will see the consequences of this only a few years down the road. Plus, if we go to the United States Senate page, which is something that Trump might have to address, they say it here. The Senate passes the Smoot-Hawley Tariff Act from 1930, and then they described it how the most catastrophic acts in congressional history because it led to the Great Depression. And even before the act was passed, US trading partners began retaliating by raising their tariff rates, which froze international trade and increased the costs to the US, global recession, depression back then, and then of course Franklin D. Roosevelt was elected as a consequence. So we have for sure many big surprises and changes. Maybe it can be on the positive, maybe it can be on the negative. What we know now is that the level of uncertainty is extremely high. Let's discuss the impact. I'm sure you know the impact on markets, but the key is also to understand, okay, there has been additional buying of copper, for example, before tariffs started, but copper, which is an indication of recession of investments of planned, is down and is crashing significantly. Similarly, oil prices have crashed from 70 what looked like the new normal to below 60. That is again an indication of what traders think and the impact of what's going on. And if we look at the markets now, everything is down severely. We'll see how and everyone will react, but over the long term there will certainly be consequences. And of course, as I already said, treasuries are down as the markets again expect lower rates and perhaps a recession. Now, when it comes to the market, we have to understand that the market is now just where it was not even a year ago. So that is also key when it comes to fundamentals, because the market is driven by news in the short term, but by fundamentals in the long term. A few months ago, the market was priced for perfection, and anything would have shocked it. So now we have these big changes in the market, but not that big when you look from a bigger perspective. The market was priced for perfection, the P ratio, the cyclically adjusted P ratio across cycles, because as you see now, you always have to take into account cycles, was 37, only higher once in history during the dot-com bubble, and closely high during the roaring 20s. That then we had tariffs, and this was the consequence of the roaring 20s for the market. I hope it doesn't happen again, but we must understand that the market was priced for bad returns going forward already, even if all things looked great. If you start to adding recessions, things like that, then you know that the market is going down from such a high level. If the market just reverts to the mean for when it gives you the 8 plus 2, 3% inflation, 10, 11% returns, then we are still 50% crash possible for those markets. So that is the high start level, news driven, expect a lot of volatility. And we don't know what will happen to tariffs, to deals, to retaliation, to recession numbers, to unemployment, the Fed reaction. Will the Fed start printing interest rates higher to prevent inflation, lower to help recessions, inflation, stagflation? Nobody knows. Will there be deals? Will there not be deals? It is very likely tariffs, lower global productivity, lower global trade, everyone is poorer. Maybe America will be less poorer than others, but a certainty is that it will be poorer. Now, we will see whether there will be inflation that might push the markets even higher on Fed printing, or just a normalization to a normal mean P ratio where you still have 50% down. When it comes to the economy, I already told you, recession, uncertainty, we don't see into the future, nobody does, which leads to lower investment, pauses, lower oil prices, lower copper prices, negative situations, lower global technology trade, thus poorer everyone, poorer productivity, things like that. And therefore, when it comes to investing in a high degree of uncertainty, always think about it is a long-term life process that we need to act despite of uncertainty. We look at the price and value and long-term competitive durable advantages. Now is where those advantages come in handy to know them, because when you look at things, okay, this will be there in 5 to 10 years, we don't know what the situation will be in 5 to 10 years. If you can make money no matter what kind of scenario is ahead of us from a business perspective, that is what you want to own. And that's what we're going to discuss in the next two videos, the market cycles, as I told you, and investing over the long term into value investments with whatever happens, I am okay mindset.